Right. Let us look at the second part of what I was talking about with this idea of cost of sales. So we had this scenario, D plus E plus A is equal to C plus L plus I. And I said, you know what, let's ignore, let's even take a high level scenario. Let's ignore A, C, and L. It's not impossible, if you think about it, it's not impossible for someone to acquire some goods on credit and O, so we just call it the trade payable, and that's the expense of the actual goods, to sell £20,000 worth of those goods for 30,000 and be owed 30,000. That's very possible, like I was saying. And like I said, if we were to compare or work out profit, we need to deduct the 20,000 from here and put it here. Now, at the end of and so we work out profit, and so what we would have this scenario where we have the D plus E. Oh, sorry, a second. Let's just get rid of this. And this is what we would have. We would have A is equal to C plus L plus I. So what we have right now is we have £20,000 is equal to, we have other 30,000 as well, the trade receivable, and that's equal to the 40,000 plus the 30,000. This is minus 30,000 minus 20,000, making this 10,000. If you like these two together. And so there's no capital right now. So currently there's a profit of 10,000, and that's what you have right now. Right? Now, I'm going to come over here and ask you and tell you what happens in the next period. So the next morning we wake up, and what's happened so far, if you like, is we had under A this this closing inventory of 20,000. This stock that we had there, if you like, from the night before. Remember, this 20,000, we transferred it out of here into our stockroom. Well, very next morning, what happens is that this 20,000 gets taken out of the stockroom and gets put again back onto the shop floor, ready for sale. Right? So now, imagine we now sell the rest of that inventory. Or imagine we buy some more. Let's just buy some more, say another £10,000 worth during the day, and we now owe this as well. So this is some new inventory we've bought. So we had that closing inventory has become the opening inventory of the next day. So you can see that now. Imagine I sold all of this. So well, imagine I did sell all of this, and I sold all of this for 50,000. And imagine, as I say, it doesn't matter, this doesn't matter, trade receivable or bank or cash or whatever. The point is that I've sold everything. I have added together my opening inventory of 20,000 plus what I've just bought in. So that's 30,000. So I'm comparing now. I can compare for my profits, my I minus all my E's. If I had had some closing inventory, I would have deducted that closing inventory like I did in the first scenario and stored it back in A, but I don't. I'm just saying that in this case, I have sold off everything that we have in that period. So profit in this scenario would be the I, if you like. I'm just going to do it here. I minus E, which is the 50,000 minus the expense of 30,000. But this expense is made up of opening inventory plus purchases. Typically, you always have some closing inventory. And if I did have some closing inventory, we would deduct that closing inventory. So what am I saying? Let's arrive at the, what I'm saying is that ultimately, when we, in your income statement, when you come to see it, when we're trying to work out what profit is, ultimately we arrive at this idea of, well, profit must be I, which we refer to as revenue, minus, minus what exactly? Minus the cost of what we have sold. And that cost must be whatever the opening inventory was, plus whatever we bought in that year, in the day, minus whatever we haven't sold. And this is the only way we will ever find out what real, if you like, what the actual profits are. So you have revenue minus opening in and minus all of this whole thing here. And this whole thing here is referred to as cost of sale. Cost of sales. And I guess it makes sense. It's saying what is the cost of what you have actually sold, not what you purchased. Yes, because you would have sold, I guess, what you started the shop floor with, if you go back a little and see on the video, and what you've bought, and whatever you didn't sell you need to take out because you just didn't sell it. And that, if you like, is you need to compare that with your revenue, right? And this I means revenue, if you like, and this means cost of sale. And we'll see this when we start looking at the income statement. But really, this is a theory that we need to look at, and so far, before we can start looking at the actual income statement. So when you're looking at the figures, everything is making sense, right? Great stuff. See you in the next video.